Billions of people across the world have been affected by one of the worst health crises of the past century. According to some estimates, about 40% of the world's population is currently advised to stay home due to the COVID-19 outbreak. The shutdown orders have prompted an unprecedented fall in the demand for oil and a plunge in oil prices. As the pandemic erodes demand, OPEC and other producers have agreed to record output cuts to tackle a supply glut.
There's certainly still oversupply in the global markets. So if we look at the estimates for April, it was nearly 30 million barrels per day, or 30% of global oil demand had evaporated. So essentially that was the surplus. Now, as we step into May, there is an expectation that demand will start recovering, but it's going to happen very, very slowly.
OPEC Plus, consisting of the Organization of the Petroleum Exporting Countries, Russia and other producers, have agreed to slash output by 9.7 million barrels per day from May the 1st.
So 23 members, OPEC and non-OPEC, are all cutting back by nearly 23%. So that's huge. But unfortunately, the situation is such that the 9.7 million barrels per day that they're cutting is just about a third of the demand that has disappeared from the market. So it's far from matching.
A pronounced supply and demand imbalance has sent oil prices to a multi-year low. Brent prices hit a near 21-year low in April. Meantime, US crude fell to an all-time low and traded negative for the first time on record.
WTI trading negative at that moment in time has very technical factors. Okay, this is basically US land-based crude, and it is basically a futures for delivery. So at that time, so much oversupply, and basically, lack of storage space forces WTI crude to go into negative.
So what happened with WTI making history with a negative daily settle was a confluence of slightly technical futures market related factors and some very fundamental supply demand related factors. Could it happen again? Nobody will tell you that it's impossible. It certainly is possible. It's not probable though, because we can already see a lot of adjustments starting to happen in the market with the current front month contract.
But what exactly does negative US crude futures mean for consumers in Singapore?
So first things first, negative WTI prices does not mean you get to pump your car for free at the petrol kiosk, because gasoline is in a separate market from crude oil. And on top of that, of course, Singapore has its own demand-supply dynamics, and of course, the Singapore dollar variable to include. But having said that, with WTI and Brent prices this low, there's a pressure for all the other energy components ranging from gasoline to marine fuel oil to follow suit. And I think that would mean lower fuel oil prices for consumers in the near term.
Singapore is a key oil refinery and oil trading hub, and depressed oil prices are likely to weigh on economic output.
This slump in oil prices, is very negative for the economy, on top of the deflationary overtones, but as well because it will affect the whole energy ecosystem, ranging from the commodity trading houses to the oil refineries, and of course the transportation, shipping firms, and basically all your networks as well. So I would say, coupled with the COVID-19 circuit breaker, the slowdown in retail, in trade, in construction, our Singapore economy is expected to contract by around 4% or more in terms of GDP for this year.
Crucially, Singapore being a refinery hub, I think it is more important to look at the refinery margins that Singapore can obtain from low crude oil prices. Because your crude oil prices might be low, but if your distillate prices are high, if, for example, your fuel oil prices are high, then Singapore has a benefit from that divergence. Right now, we are seeing a collapse on the end user side, from gasoline to jet fuel, and we are also seeing a collapse on the input material side, which is crude oil. And from what we are seeing right now, crack margins are very low, they are very tight, very suppressed, and that does not do well for Singapore as a crude oil refinery hub.
Oil markets have seen huge shocks before. For example, during the Great Depression and the Asian financial crisis, oil faced dampened demand. This time round, if demand were to pick up as lockdown measures are eased, we could see prices recover sooner than later.
The worst impact in terms of the supply-demand imbalance and the pressure on prices is still expected to be Q2. Now, once you come to Q3 and Q4, the hope still is that demand will start recovering. And then, of course, you have that combined with the impact of OPEC, non-OPEC cuts. And, other US, we expect close to 1 to 2 million barrels per day of oil to start disappearing from the US production in June and July. So the scenario essentially is of a second half of the year starting to rebalance. For the whole year, I would still put my estimate for Brent to be somewhere between $30 and $40 a barrel.